Good afternoon, everyone, and welcome to RCBC Hexagon Club's investment forum entitled Unlocking New Investment Opportunities. Hexagon Club is RCBC's premier club that offers a premium banking experience. With its exclusive perks and privileges, it provides clients the flexibility to maximize their funds' potential depending on their financial objectives and priorities. This forum, which is just one of this year's Hexagon Club exclusive online experiences, comes at a pivotal moment. Here we are in the early days on the other side of the pandemic, the Philippines just about to play catch up in the reopening narrative, central banks moving the time for ending ultra-loose monetary policy. And in an unexpected twist, the world now looks on in horror as Russia intensifies its attack on Ukraine in what experts describe as the West's biggest geopolitical crisis since World War II. And while that war is happening halfway around the world, the rest of us have had to deal with painful sticker shocks from oil to metals to wheat. What should investors do now? How much dry powder should you keep? And how do you score top returns? In today's forum, we'll talk about the outlook for the next 6 to 12 months for both the real economy and the financial markets, and discuss ways to play the economic recovery and volatility through different investment opportunities. But before that, let's first hear a few words from RCBC's Executive Vice President and Head of Retail Banking Group, Mr. Richard Lim.
Michelle, good afternoon, everyone. And I would like to welcome our valued Hexagon Club members for joining us this afternoon. I'm sure all of you are very busy, but thank you very much for being with us this afternoon. As Michelle said, I'm sure all of us are very excited to know what investment opportunities we can do amidst this still volatile environment. So please rest assured that as a Hexagon Club member, we are continuously working to further make your experience banking with RCBC as pleasant as it can be. And please, if you need anything, don't forget or hesitate to call your dedicated relationship managers. Thank you very much, and good afternoon, everyone.
Thank you very much, Mr. Lim. Now, how does a pandemic-infused version of economic normality look like? To give us an economic and investment outlook, allow me now to introduce RCBC's Chief Economist, Mr. Michael Ricafort. Now, Mr. Ricafort was recognized by the Department of Finance as the most accurate in predicting the GDP growth for 3 consecutive years already. Ladies and gentlemen, please welcome Mr. Mike Ricafort.
Thank you so much, Mimi, for the generous introduction. A pleasant afternoon to everyone. So I'd like to start my presentation with the forecast for the year. Okay, next slide, please. So we see GDP growth between 6 to 6.5%. That already incorporates the effects of higher oil prices because of the war. It could eat GDP growth by about 1%. The dollar peso could range 52 to 53. But of course, the BSP has been transparent in saying that it has been providing some order and stability in the market. It has been there to smoothen the volatility. It was at 51.50 from January 1 to March 3 until late and as of March 15, the high was 52.9. And so going forward, it will be a function of that, of the BSP smoothening activities. Inflation would pick up to 4% levels because the war is still uncertain. We don't know when this would end, and this resulted to elevated prices of oil, energy, and other commodities. However, oil prices already reached a peak of $130 more than a week ago. That was last March 7. It went down to as low as around for 3 days until yesterday. It was doing around 95 to 96. As of today, it went up by $10 to 106, but nonetheless, it's still lower by $24. How was it prior to the war? It was doing at 92 the day before the invasion. So that could still lead to higher prices of oil being imported by the country and other commodities such as wheat, soybeans, corn, those that are used for feeds, for livestock, for fisheries, for poultry. So there could be potential pass-on effects. So we're anticipating if there would be adjustments on wages in the coming weeks and months, as well as any hike on transport fares. So everybody else is looking for risk of second-round inflation effects, as the monetary authorities are closely watching that. Well, the BSP also reiterated, we haven't, well, never had we seen a very transparent BSP. And that goes even if you look at the other global central banks. It has been very transparent lately when it comes to its foreign exchange policy and monetary policy. Well, it reiterated that even after the war started between Russia and Ukraine, policy rates would remain the same. At least for the first half of the year, they would consider probably towards the second half of the year in view of the Fed rate hikes, because the Fed already raised by 25 basis points yesterday and signaled another 6 quarter point hikes for the rest of the year and 3 to 4 quarter point hikes by next year. And the possibility of deciding on reducing its balance sheet by next month, all to tighten monetary policy in an effort to rein in or better control inflation and inflation expectations that are already elevated at 40-year highs for the CPI at 7.9%, still exclusive of the effects of the war. So the policy rate of the BSP from the record low of 2%, maybe later this year could go up to 2.75 to 3%. The Fed funds rate, it came from almost zero, a range of 0 to 0.25 record lows. Now it's higher by 25 basis points. So it's going to go up to 1.5 to 1.75%. And finally, for the PSEI, currently at a little over 7,000, it could end the year between 7,500 to 8,000, because in view of some possible euphoria over the elections. Well, of course, the sustainability of which would be a function of the continuation of reform and policy measures, especially good governance, ESG related, since the rest of the world, as well, the global investments have been very keen and particular about ESG compliance. Okay, next slide, please. So even the multilaterals, they're looking at least 6 to 7% growth this year and at least 6% growth next year. Next slide, please. Inflation, well, it would be at 4% levels this year. Well, first 2 months, it was at a one-year low of 3%, after an average of 3.9% last year using it. Next slide, please. So this is the economics of oil. The oil bill is around $40 million per day, assuming now at about $100 per barrel. That's $1.2 billion per month. That's why the dollar peso has been partly affected because of that lately, at least for the past month. Or that's about $15 billion per year. That's equivalent to 3.5% of GDP. Now, the sensitivity analysis, every $10 increase in oil would lead to an increase in the country's oil bill somewhere between $1 billion to $1.5 billion. If there's no demand destruction, it's around $1.5 billion. Now, oil prices have already gone up by at least $30 per barrel since, lately. We're now doing at 106. We ended the year at 75. So that's an equivalent, an incremental, a net increase in the country's oil import bill, somewhere between $3 to $4.5 billion. So that's equivalent to around 1% of GDP. That's the drag on the country's economy, because what would otherwise be spent to boost consumer business spending as well as investments and the creation of jobs, that would otherwise go to paying higher oil that's being practically imported by the country. So that's a drag. Okay, next slide, please. So the leads. So now, well, it's still the war that's still uncertain, as mentioned. Oil prices, which remain volatile, but at least we already saw the peak. That's at least a bright spot, a source of hope for the meantime. But of course, it's we have yet to see in the coming days if these levels would be sustained, because the world would be definitely shifting away from the reliance on imported oil and the reliance for they would also, countries like the US, they already stopped importing any energy product from Russia, and the UK already would also stop importing crude oil on a fixed basis. So there would be, even EU, which sources about 40 to 45% of its natural gas from Russia, they would already diversify. uh, their sources away from Russia, and even from oil per se in recent years. We have seen past spikes of oil prices, especially in 2008. The peak back then was $147. That was the previous record rise. During that time, and also the previous peak, the last time that we saw above $100 was in 2014. So the world has already learned how to reduce reliance on oil. Even in the Philippines, relying more on renewable power, such as solar, which has, well, all of them have become cheaper in recent years. That's why there's greater motivation in view of the commitments by many companies and many countries around the world, even before the war, to reduce their carbon footprint, or to practically reduce it to zero for the coming years and decades. So what would that mean? There would be this massive investments in renewable power, such as solar, wind, hydro, and of course, even to some extent, nuclear, away from oil and other coal and even hydrocarbons. Especially if the world better adapts, especially in view of the supply chain disruptions lately, and as maybe both aggravated by COVID and the war. So yeah, that would be the shift, or that would be the shift in the coming years. So it would favor renewable power, electric vehicles, even self-driving vehicles, and away from oil per se, coal, and also less reliance on Russia for vehicles. Okay, we've seen also the U.S. stock markets correcting lower recently because of the deliberate effort by U.S. and global companies to stop doing business in Russia, stop exporting, stop importing, and close their businesses there. So it would be very hard for Russia again to attract investments. Okay, next slide, please. So, yeah, so these are the implications as mentioned, because Russia is is a major producer and exporter of oil, 10 million barrels per day. That's the biggest after Saudi Arabia and US, among the big leagues. It's also the biggest supplier of natural gas, as mentioned, at least 40% of the EU supply. And Russia and Ukraine together, they account for a quarter of wheat trade worldwide, and that includes flour, which the country imports, as well as 20% of global corn trade. Okay, next slide, please. Okay, next slide, please. So the implications, definitely, there would be higher prices being paid by the world. It's a deliberate effort also by the world to boycott many countries, especially Western countries, to boycott Russia. It's like saying they don't care if they don't have, they would reduce their sales, their income, their valuations. That's why the global stock markets have been correcting lower. They don't care, just to condemn the war. And the US already, and UK, they already started to stop importing crude oil from Russia. Actually, US, all kinds of energy from Russia. It's also signaling to the world that they don't care if they pay higher energy prices just to condemn the war. So that it's all, everybody else in the world is making that deliberate sacrifice and choice. Okay. So lives really matter, especially compared to profits or the price that they pay for energy and other commodities. Okay. So to mitigate that, the country's economic team proposed to further reopen the economy. So there would be an alert level one nationwide being proposed, the resumption of in-person schooling, reduction of import tariffs on some food items, other intervention measures such as increased subsidies on agriculture and transport sectors to mitigate the adverse impact of rising oil prices and to reduce the pass-on costs and to mitigate the inflationary impact. Okay, next slide, please. Okay, so next slide. So here's the graph of oil as mentioned. Okay, next slide, please. So at least it's down from 130. It's now 106. Okay, next slide, please. So since the start of the year, it's still up by 36%. So hopefully there would be some partial rollbacks. Next slide, please. Then this is the oil import bill, as mentioned a while ago. Next slide, please. As we mentioned, the economics of oil. Natural gas prices remain elevated. Next slide, please. Yeah, at least global commodities already corrected lower from their highs, the highs that we have seen last week. So it's still up by 27% year to date after rising 47% in 2021. Next slide, please. Okay, even coal, okay, elevated, came from record highs. Next slide, please. So although it already corrected lower by $100 per ton, it's still doubled. Barely, we're not yet done with the third month of the year. It already doubled. Last year, it more than doubled at 110%. Next slide, please. So implication of that, of course, higher energy prices because we also import some of the coal for electricity. Even wheat prices, the one used for flour, okay? So among 14-year highs lately. Next slide, please. It's still elevated. It has gone up already by 37%. Barely, we haven't finished the third month of the year after rising by 20%. Next slide, please. Even corn went up. Okay. Next slide, please. So it's already up by 24% after rising by 22%. Full year 2021. Next slide, please. Soybean prices also, okay, among near decade highs. Next slide, please. So it's up by 25% after rising by 1% in 2021. Next slide, please. Even nickel metals. Okay, next slide, please. So it's already doubled because of some of the short squeezes, derivative products, some short selling by a tycoon, what with those shorts. So the markets are trying to cover those shorts. So more than doubled, 131%. So it could benefit some of the local producers since Russia is a major supplier of nickel to the world, and in view of the boycotting of Russia in many respects, so diversification of nickel sources, and that would benefit. It's why is nickel important? Because nickel is part of the supply chain for electric vehicles, for batteries, on top of its conventional use as a material for stainless steel for many years and decades. And there are local producers of nickel that could benefit, as already reflected on their sales and income and valuations. Next slide, please. Copper also, this is part of the supply chain for renewable power. So it has gone up since Joe Biden won. Okay, next slide, please. Because Joe Biden has been pushing for renewable power. It's a matter of policy, but not shale. He's against shale. That's why, unlike before, there was the use of shale as a source. Okay, so it has gone up by 3% after rising by at least 25% over the previous 2 years. Next slide, please. Even gold. Gold is near record highs. It reached briefly last week above 2,000. Now it's around 1,930. Still elevated though. Next slide, please. So it's up by 6% from after declining 3.6%. Okay. Next slide, please. So here are the bright spots for the Philippine economy. Maybe I'd like to end in these slides. This is really worth noting. The further reopening of the economy, we're already at the lowest alert level, provided that the minimum health standards are maintained. Then also, we already shifted to granular lockdown since November. It's practically reopening the economy. We have really, the country has to say goodbye to the large-scale lockdowns that we have seen in the past. The ECQ, MECQ, they're all things of the past. GDP is would be back to pre-pandemic levels after 2 lost years. So it could happen anytime within the year, given the election year. Then inflation at 3% levels, but this would pick up to 4% levels. That would be our base case. And the worst case would be close to 5%. The worst case would be a little less than 4% because of the normalizing inflation base. OFW remittances among record highs lately, a bright spot despite the pandemic. Next slide, please. Because of the need to send to the beneficiaries because of the pandemic and higher inflation. Exports, imports, trade deficit, all near record highs because of the global economic recovery. But the imports and trade deficit would be bloated by the higher prices of global commodities being imported. Unemployment rate already the best since the pandemic started. The latest data that came up this morning, 6.4%. Manufacturing gauges also the best. One gauge, the PMI, the highest since record started in 2019. It even exceeded the pre-pandemic levels. So there's action there on global trade and manufacturing. Even tourism already started after an absence of nearly 2 years. So this is very important to support many industries, especially the hard-hit ones, those allied and related to tourism. So before the pandemic, it used to be $6 to $7 billion. So it's gonna go. Well, it would pick up already. There's already a total of 100,000 so far foreign tourists that came since February. So that's one of the bright spots. That's one of the missing elements of the recovery. And together with face-to-face coding being proposed already to be shown. So yeah, that would help normalize. That would help many other related industries. So these are the missing elements towards greater normalcy. And that is also good for the country's long-term economic growth and development, as well as overall productivity for the coming generation. So with that, I'd like to end my presentation. So please feel free to ask your questions later on during the Q&A. Thank you so much, and have a pleasant afternoon to everyone. Back to you, Min. Thank you.
Thank you so much, Mr. Mike Ricafort, for that very comprehensive outlook for the macroeconomy. Now, our next speaker is the head of RCBC's Trust and Investments Group, Dr. Robert Ramos. Mr. Ramos has more than 25 years of banking and finance experience working for local and foreign institutions. He is a CFA charter holder, a CAIA charter holder, a CIPM certificate, certified securities representative, a registered financial consultant, and a certified treasury professional. He has served as president of the Trust Officers Association of the Philippines and the De La Salle University Doctoral Society. He is also the current president of the CFA Society of the Philippines. Here to talk about trust and investments, ladies and gentlemen, please welcome Mr. Robert Ramos.
Thank you very much, Mimi. Always good to have you. Anyway, let me give you a short presentation on the potential investments that you can use with regards to trust and investments. Next slide, please. So my discussion points this afternoon include unit investment trust funds, exchange traded funds, and maybe a short investment outlook and how I can tie that in with regards to possible outlets that you could choose. Next slide, please. Just a quick summary. What are UITFs? Next slide. UITFs are effectively pooled funds. They're formed by contributions of various investors. These pooled funds are managed by professional fund managers such as RCBC Trust and Investments. Who can invest? Effectively, retail clients, mass affluent, high net worth clients such as yourselves, and even corporate clients can invest in these off-the-shelf unit investment trust funds. Next slide, please. So how does this work? Effectively, what happens is investors give funds. These are pooled, given to fund managers, and the fund managers, based on the mandate of the fund, invest these in various investment outlets. These outlets can be either cash, money market, fixed income, equities, or even balanced funds. Next slide, please. So why invest in UITFs? Effectively, when you invest in UITFs, you can access higher yielding assets rather than leaving these funds in just your settlement account or checking account. You can choose to invest in something else that will, give you a better yield. These are affordable rather than waiting for your funds to accumulate to maybe ₱1 million. For as low as maybe 5 or even 10,000 pesos, you can already invest in various UITFs. These are diverse. If you invest in one UITF, you're not just investing in one particular asset. Effectively, you're investing in 4, 5, 6, 7, or even 10 underlying assets when you invest in one UITF. And these are very, very accessible. Next slide, please. What do I mean accessible? You can go to any RCBC branch and transact over the counter to the branch nearest you. If you have an RCBC trust account, you can contact any of our trust marketing officers. And even better, I think this is one thing that we learned during the pandemic. If you have an RCBC online account, on RCBC mobile app, you can transact online. Next slide, please. These are our most popular unit investment trust funds. We have a lot more, but just to give you a flavor, from left to right, these are our funds that become a little bit more aggressive. One of our more conservative funds are the Peso Money Market Fund. These are actually invested in fixed income securities, cash, and money markets. The minimum initial participation is just 5,000 pesos. Among the funds that I'm showing here, this is probably the least risky, but of course, it doesn't generate that great of a return. For those investors with a greater risk palette, you can actually invest in our RCBC equity fund. The minimum is still the same, but the target market is aggressive and sophisticated clients. Again, this is a little bit more aggressive, but this has the potential of generating a little better returns. If you want to be exposed to maybe the US markets, at the same time, you want to minimize the exposure, You can look at our newest fund. This is the RCBC US Equity Index Feeder Fund. It actually allows you to be exposed to the top S&P 500 stocks in the US market for as low as $200 US. Next slide, please. So what are the product risks that come along when investing in new ETFs? Effectively, this is not a deposit product. There are no guarantees of principal or income, and thus it's not covered by deposit insurance. There is also a possibility that the value of investments in the fund will fluctuate. If it goes up, well and good, but sometimes the value of these investments may go down. Next slide, please. For those investors that have a little more money and have a greater risk palette, I'd like to talk to you about exchange-traded funds. These can be accessed by an investment management account here at RCBC Trust. Next slide, please. What are exchange-traded funds? An exchange-traded fund is basically a marketable security. It can track an index, a commodity, a bond, or a basket of assets like an index fund. Case in point, I want to be invested in the top S&P 500 stocks in the US market. I can do that via an exchange-traded fund. Let's just say I want to access the price of gold. I can do that via an exchange-traded fund. The same way, if I want to access oil, I can do this via exchange-traded funds. Next slide, please. Why invest in exchange-traded funds? Effectively, they're liquid, especially for the bigger exchange-traded funds. You can trade them across global markets. They are diverse. Effectively, as mentioned, one example is the S&P 500 exchange-traded fund. Rather than buying 500 separate stocks in the S&P 500, I am just buying one exchange-traded fund, and I effectively have exposure in that market. It's flexible and cost-effective. Using that same example, if I am buying, if I want exposure rather to the S&P 500 index, rather than buying 500 separate stocks in the S&P 500 and paying 500 stocks worth of brokerage fees, I'm effectively just paying for the brokerage fees of one exchange-traded fund. Next slide, please. Here is a summary of our most popular exchange-traded fund here in RCBC. We make this available. There are a lot, but this is just a flavor. The most popular that we have is the iShares Core S&P 500 Exchange Traded Fund, IVV. This is actually offered by one of the bigger fund managers, BlackRock. It seeks to track the investment results of the large cap US equities. For those who want a more broad-based exposure and don't want to be exposed to US equities, you can take a look at the IXOS, or the iShares Core MSCI Total International Stock ETF. This particular ETF seeks to track the investment results of large, mid-cap, and small-cap non-US equities. However, if you want exposure to commodities, you can take a look at the iShares Gold Trust ETF, or IAU. Next slide, please. Who can invest? As mentioned, this is for investors with a greater risk palette. You need to open an investment management account here in RCBC Trust, and the minimum that we ask for is roughly about $30,000, effectively easily affordable among you Hexagon clients. But there are parameters. You have to be a qualified individual buyer. How do I become a qualified individual buyer? You need an annual gross income of at least 10 million or more. You need to have portfolio investment securities of at least 10 million or more. You have to have minimum personal net worth requirements, and at the same time, you have to have securities trading experience to be a qualified individual buyer. Next slide, please. What are the risks of investing in an exchange-traded fund? Like a UITF, of course, there is volatility in the value of the investments. It may move up and down depending on market prices. And since these ETFs are traded across global markets, there is a time difference related to order taking. At the same time, being traded in global markets, sometimes markets are closed and there are holidays. Next slide, please. So just to relate these products and maybe Mike's investment outlook earlier, what product would fit me depending on what's happening right now? Next slide, please. Obviously, Mike said this, and I represent this by a graph. If you look at the Philippine yield curve and the US yield curve, what's happening? interest rates have been going up. They have been creeping up because of global concerns, because of inflation, and because of the battle between Russia and Ukraine. You know, effectively, what happens when interest rates increase, bond prices decrease. So if you are holding a bond portfolio, effectively, your bond portfolio is suffering some losses at this point. Next slide, please. So if you are interested in investing in fixed income, one thing that you could do is probably wait it out, wait till interest rates move up, and you can probably buy it at that point so that you don't suffer as much losses, or you invest in a fund that actually is more liquid and is not impacted as much by these interest rate movements. So one thing that I would like to offer you, if it fits your risk palette or risk profile, is the RCBC Money Market Fund. This particular fund invests generally in short-term securities, and thus is not subject so much to interest rate risk. For the US fixed income investors, likewise, you can wait it out. You can wait until you can invest when the yields have spiked, when the returns are probably adequate for you. But with rising interest rates, people have been flocking to commodities, maybe commodities such as oil, or commodities such as gold, and Mike also mentioned this earlier. So one option, if you want exposure, you can look at the iShares Gold Trust ETF, or the IAU. Next slide, please. If you can look at the equity performance, you can look at the various US indices, and they have been dropping. The Philippines, luckily, has not been as impacted, although we have been impacted as well. But the NASDAQ has taken a beating. This is as of yesterday. It's taken the biggest drop simply because of its exposure to tech stocks. So next slide, please. So how do you relate? How do you manage that if you're looking at peso equity investments or global equity investments? One thing that I'd like to share is that, maybe look at the bluest of the blue. Look at stocks who have weathered the storm and who have the potential to ride with the reopening of the economy. So that being the case, you can look at the RCBC R25 Blue Chip Equity Fund. These are the biggest stocks that we have here in the Philippines and have been quite established. On the global equity side, of course, there are still some more concerns. There's a concern about, the impact of Russia's invasion of Ukraine. That's being felt worldwide. So rather than investing in a US fund that is looking at capital appreciation, one thing that you can look at is investing in an ETF that has access to stocks that are in mature industries, industries that have been around for quite some time and have weathered the storm, and industries that give a very decent and attractive dividend. That being the case, you can look at the iShares Select Dividend ETF, or the DVY. Next slide, please. So I'd like to thank you, and that's my short presentation. Back to you, Mimi.
Thank you, Rob, for that interesting presentation. I'm sure our viewers have a lot of questions, which we'll take later on. Now, at this point, we'd like to remind all of our participants to please join the conversation, send in your questions, type them in the Q&A button found at the bottom of your screens, and we'll tackle them later on during our panel discussion. Also, we'd like to let you know at the end of this program, we will be raffling off some e-gift certificates to 10 lucky winners. So please make sure to stay until the end of the program. Moving on now to our next speaker. He is the head of retail sales and online marketing for RCBC Securities, Mr. Antonio Garcia. Antonio brings with him over 20 years of experience in the business of stock market and online technology, financial planning, wealth management, portfolio construction, asset allocation, estate planning, and stock brokerage. He has held various positions at investment houses and financial institutions such as MBG Capital, Sun Life Philippines, AGJ Securities Corp, and UOB Securities Philippines. Now, joining us to talk about investing in the stock market, ladies and gentlemen, please welcome Mr. Antonio Garcia.
Thank you, Mimi. Appreciate the introduction, and welcome to everyone this afternoon. I know it's a Friday afternoon. We're closing out the week, going to the weekend. So thank you for sticking around. We have lots more to share with you. And I'll go straight into this. Next slide, please. I'll just quickly go over, because I think Mike and Rob already talked a lot about what I have to talk about in terms of the outlook, right? So, but just to recap for us, RSEC, recovery in GDP and corporate earnings definitely will support the market's upturn. COVID's receding to the background right now, and the two main issues in front of us are the Ukraine war and the presidential elections coming up in May. So the 2 months away. Next slide, please. Just quick again, I mentioned May elections probably will be the key thing moving forward. Next couple of months, there'll be a lot of discussion, a lot of thought about that. COVID, not so much. We're hopefully at the end of that, and hopefully no more new strains as well. And the third catalyst here, really just the return of foreign investors into the market. Next slide. Maybe we'll skip this as Mike already touched on the risk. But again, inflation risk, fuel prices, it can kind of affect everything going on here as well. So that's something that we really need to look at. Next slide, please. In terms of presidential elections, Bongbong and Sara are still leading. In the surveys that we're seeing, we believe that the electorate, the business community will largely accept the election results for as long as there's no widespread cheating or anything like that. So hopefully, whoever comes in can move the economy further forward. Next slide, please. Just a quick slide about foreign investing and outflows. As we can see, 2020, huge foreign outflows there on the right, leading to 2021, about 3/4 of that as well. This year, we're still seeing a lot of foreign selling, but hopefully that, as things improve, that will get less and less and turn to foreign buying. Next slide, please. So 9-month core net income results are generally in line with our expectations, about 51% average rise in various companies that we cover. We forecast another 31% rise in net income for the full year 2022. Hopefully, no more incidents and we can really see this 31% come into play. Next slide, please. Of the companies that have disclosed their full year earnings for 2021, all but one, Globe there you can see came in below our expectations, and SM came in above our expectations. But generally, everyone was in line with what we're expecting in terms of their income for 2021. Next slide, please. So just to recap, we're looking at 8136 on the index for the end of the year. Today, the market closed at 7007. So just on this alone, and if things work out, that's a 16% upside just on the PSE. So individually, we expect other stocks to perform much better than that. Again, we're on track towards economic recovery, reopening in March, and hopefully moving forward after elections. Election campaign spending should drive the market, particularly in drawing a blank here. Sorry, guys, senior moment. Yeah, so election campaign spending should drive the market further. Again, oil prices, kind of a dampener at this point in time. We could see early this week when oil shot up. Gas fuel was raised prices by, I think diesel was up an average of 13 pesos. The market really took a big hit. Closed down 4% on that day. Next slide, please. So just our updated stock picks. I wanted to just give you an idea of what we're looking at. We're overweight on the consumer companies that are poised to benefit the most from the full economic reopening. However, we have limited our exposure to consumer companies with lower pricing power to pass on inflation. Second, we continue to be bullish on companies with high exposure to consumer spending in the banking and property sectors, and MREIT rounding out our sole REIT pick among our top picks here. And again, we expect the Russia-Ukraine conflict to accelerate adoption of renewables. I think Mike touched on that, and that's something that I personally feel is the wave of the future now. And on the renewable sector, we chose AP as our top pick for the next 12 months. By the way, this is a 12-month horizon that we're looking at. Next slide. So just quickly, I just wanted to highlight the returns. Oh, back one slide, please. Back one slide. There. Yep. So closing prices as of yesterday, the market tapered off again today due to the rebalancing. So some of these prices are actually a little bit lower, presenting a higher total return over the next 12 months. So there's a lot of opportunity still in the market. Again, there's a lot of volatility as well. So it's something that we have to all look at in making our investment decisions. Next slide, please. All right, so just quickly, yeah, there we go. Just RCBC Securities. I know we all back with RCBC. We may not be so familiar with RCBC Securities specifically. We're the stock brokerage arm of the bank. We're a trading participant of the PSE. Trading participant really is just a fancy way of saying stockbroker, but PSE likes to call them trading participants. And we deal in Philippine listed equities only. We don't do Forex, we don't do bonds, we don't do ETFs that Rob offers, purely Philippine listed stocks, so just common and preferred stocks on the PSE. Next slide, please. Yeah, there we go. So we have two types of accounts. If you want to start trading with us, you need to open a separate trading account directly with us. We have an online account. And for the purpose of today, I'll be discussing more about the online side than the traditional side. But online, you create your account online through our website. I will show you that in a few minutes. Once that account is open, you execute your trades through the portal. You buy and sell as you wish, post your prices, depending on your objectives. And the second one is a traditional account, which is the more old style, where you would call the broker, or call me, or our trade desk to place your order. We would take your order, post it or execute it if the price is available at that point in time, and then confirm to you, right? So it really depends on what you like. I do want to point out that whether you're online or traditional, you have access to us directly. Don't feel that maybe if you have an online account, you can't really speak to any brokers, ask for information or other things you need from us. So either way, I don't segregate. We don't segregate, me and my team. Clients are all clients, and we talk to everyone the same way. Next, please. Yeah, so this is our website. So if you want to open an account, you visit rcbcsec.com. There's two tabs right there that you can use to open an account. Those will jump immediately to the account opening pages where you start filling your information. What I did highlight here is on the right. If you're opening a traditional account, on the very right there, they're downloadable forms. So you can just download the forms and fill those in if you're opening a traditional account. Also, our FAQs on the top there are available, and it goes through every single step of the account opening process. But again, if you need information, please contact your relationship managers, or you can contact us as well directly at the end of the presentation. My email will be shown there quickly. Next slide, please. Yep, sorry. So just the quick process. Again, you log on to our website, click on the link to open an account. You will go through typical filling up of the forms. This is all done online. Today, step 4, as you can see, you still have to download and e-sign the documents, but hopefully by April 1, we will be fully online, meaning even your EKYC and your facial recognition and liveliness check will be done directly online. Once your account is opened, you need to fund it to be able to trade. Particularly for online accounts, need to have funds in them before you can buy. Traditional accounts, you get T+3 credit effectively, right? And that's the process. You'll go through in this process we're talking about today. You'll go through a Zoom interview to ascertain your identity and some of the information that you provided us. Next slide, please. Okay, so what I didn't mention is it costs you nothing to open an account. There's no minimums, so you can open an account anytime you wish, even if you're not intending to use it immediately. It gives you access to the market, live information, research reports, all available there, charts, and so much more information. It's a very robust site. But In the event that you do intend to start trading, these are the charges and commissions that you'll be subject to. So when you buy, there's an amount that is added to your gross proceeds. So you can normally look to add about 0.3% on top of what your shares will cost you. On the sell side, a deduction, when the proceeds are paid to you, there's a deduction for all these charges and commissions and so forth. So you can look to about a deduction of 0.9% approximately. You know, I do want to highlight over here the sales tax of 0.6% on the gross value, and that's really the big difference why buying is a 0.3 total charge and selling is 0.9. But just factor in that when you buy or when you sell, whether you make a profit or a loss, there is a sales tax. It's a final tax, but there is a tax on the sale. It's not a tax on the profit. So just bear that in mind when you're executing your transactions. Next slide, please. Yep. So our online platform is called Easy Trade. Again, I mentioned to you, it's a very robust platform. It allows you, particularly now with our mobile app, which we launched actually early last year, it allows you to really trade anytime, anywhere, and it's easy as that. That's our tagline. But next slide, please. As I mentioned, it's a very robust site. Unfortunately, the screen's a bit small, but you have all the functions up here. Your quote page, your trade page, your analytics, your research, your news, your charts is all available for you. This screen on the right is really just the trading page where you enter your buy and sell transactions. And as you can see, there's a 3-step process there. Basically, that process is a confirmation process. And just this morning, we actually had a client who was worried about trading online because she felt that she might make a mistake and execute the wrong trade. And we said, no, there's this confirmation process. So you're assured that you're trading and entering your trades as you wish. Next slide, please. And here's some screenshots of our mobile app. It's not as robust as our online app, but it gives you what you need to trade on the go. So if you're on the street, if you're in the car, and please don't trade while you're driving. But if you're on the move, you have access to the market. There's a ticker. You can view quotes. You can check your watch list, and there on the right you see a very simple chart that it also gives you. So you can look at charts, and I believe it's day, week, hour, minute, and various charts available there. Next slide, please. So again, we're more of a service than in products, but in terms of products, yeah, our research produces several reports. On a daily basis, we do a morning guide and a daily recap. So one comes out before trading, one comes out at the end of the day with all the information that's happened. Next slide, please. We also do technical notes. If you're a chartist or technical analysis is your thing, then on a daily basis, some of the companies that we discussed during our morning call here at RSEC, we distribute to our clients. Next slide, please. We also do both company updates and next slide, company reports, full-blown company research. So these are longer documents, maybe 10 pages with a lot of information based on our discussions with some of the companies that we cover. Next slide, please. And the last one, if there's anything among the products that we distribute, this valuation table is probably the one you want to be holding in your hands every day. It's a 3-page document with all our recommendations, all the fundamental metrics available. Our recommendations change on a weekly basis. Our target prices change based, if we do have changes, that's all reflected there. So very powerful document to really guide you through your investment decisions. And the next slide, please, is the last slide, I believe. Yep. So we're on social media. You can follow us on Facebook, on Twitter, Instagram. All our information we push out on social as well. So if receiving an email takes too long for you, have to read it, you can read the snippets on our social media. And on the right, again, that's my email. Please feel free to reach out to me or to Ira, who's on my team. I would be happy to help you. Conversely, again, just talking to your branch relationship managers, they understand the process. I've briefed them as well in the past, so they know how this works. But yeah, that's the end of it. Mimi, I'll turn it back over to you.
Thank you, Tonyo. I'm sure a lot of our viewers will be getting in touch with you and your team soon. Now it's time to introduce our final speaker. He is David Lee Chu of Lee Chu Property Consultants, the leading commercial real estate broker here in the Philippines. He has arranged the lease of more than 1 million square meters of office space and sold more than $2 billion in real estate. He currently sits at the board of the IT and Business Process Association of the Philippines, or IBPAP, and has been instrumental in steering the Next Wave Cities initiative since its inception in 2009. Here now joining us to talk about investing in real estate, ladies and gentlemen, please welcome Mr. David Lee Chu. David?
Hello, Mimi. Good to see you again after so long. And hello, everyone. Thank you for having me over. I understand I have 15 minutes, and so I'll go straight to the slides. So I've been asked to give an overview about what's going on in the property market vis-a-vis investing, vis-a-vis COVID and Russia. So I hope I'll be able to meet expectations here. Next slide. So I guess the COVID crisis and this new Russia crisis is really hurting a lot of economies around the world, and yet the property market in the Philippines is generally holding. And what I mean by that is the middle market and below is certainly being hit hard by this crisis. But the upper middle market and above has been doing pretty well in the Philippines. And I attribute that to three key items. First is a structural reform in both government and policies that make it easier for Philippine business to happen. The second thing is, sorry, I think we're having a technical issue. There's feedback. Are you guys? Give me a few.
There, perfect.
Is this better?
Yes.
Okay, good. Thank you. Okay, so as I was saying, the property market in the Philippines has done surprisingly well despite COVID and despite the Russian crisis. And I attribute that to three things: structural reform in both the government and policy that make it easier to do business in the Philippines, but also the buttressing from the overseas remittances, which is now 35 billion plus a year, and the BPO sector, which continue to employ people in the Philippines, especially in the COVID crisis and this Russian crisis. In fact, I've done a survey of the 10 largest tenants in the Philippines, the biggest employers in the Philippines, and they all had record years in 2020, 2021. And that's because every time the West goes into problems, economic problems, like the ones we're going through right now, more and more jobs are going to be created in the Philippines. And because of that, the property market's doing so well. The office market continued to enjoy growing demand for office space despite the oversupply. Second, capital values, land values all over the Philippines continue to stay steady, if not climb. And third, the residential market in both the exclusive villages as well as the condo market from the upper middle condos and above continue to hold in value despite the contraction in the economy and despite the contraction in rental rates. And again, all that would not be possible without the three things that I've mentioned to you. Next. I have been criticized to be quite optimistic in the last 24 months. Some people say that I'm in denial of the realities of things, and I want to assure you that I am fully aware of what is going on and the hardships of millions of Filipinos through this COVID crisis. And I'm doing my part in trying to remind people of the good things that have been happening in this country despite COVID, Russia, and the elections. And this slide will show you and validate to you the 20-year boom that we have been going through despite all the issues that we've been through as a country. And the COVID crisis, the Russia crisis, the political crisis is nothing new for Philippines. And as you can see, despite all these issues that we've had before, the market continued to grow. Yes, there are millions of Filipinos suffering, and the property market in the middle and below have been decimated. That's where you see the highest foreclosures in condominiums, in real estate, in cars. But in the upper middle and above, it has done surprisingly well. Next. And it's not just Metro Manila. Despite building 50, 60 townships all over Metro Manila, we have consumed almost all these townships. And even through COVID, we are hitting all-time highs. We have properties in Makati, very prime locations that are going to sell at 1.7 million pesos per square meter. And when that happens, it will be the record for Makati. We have properties in Bonifacio that are right now transacting at 1.7 million pesos per square meter. We have properties in El Nido, in Cebu, in Ortigas Center, all over the Philippines hitting record highs. Next. And again, like I said, it's not just about Metro Manila, it's all over the Philippines. This boom is benefiting many parts of the Philippines, not just Manila or Cebu. And two things I want to highlight are places like Iloilo and Palawan that have completely been transformed in the last 15 months despite all these challenges. Next. I want to talk about the office market briefly. Next. This is the 6-year picture of how demand has performed every year for the last 6 years, broken down by sector. And there are 3 general sectors: the POGO sector, the BPO sector, and everyone else in the corporate multinational market. And you can see that the last 6 years, these are very, very big numbers. And despite COVID, these are still very big numbers. And to the point where 2017, 18, 19, the Philippine office market, and more particularly Manila, became one of the top 3 markets in the world for office leasing. And while the POGO sector is quiet for now, and it was quiet for the last 24 months, the BPO sector continued to take space. And I can tell you that the BPO sector could have taken more space if not for work from home. And for as long as they will continue work from home, then they will not need as much space as they used to. If work from home is not an option for them, they would have taken significantly more office space than what they have in the last 24 months. And even at these numbers, even at a 6-year low for the BPO sector, this still makes us one of the highest office markets in the world through COVID. Next. And the other piece of good news is that the rate of termination, so the yellow line shows you the total contractions of office tenants, and you can see that even through COVID, the rate of contractions have rapidly declined. Yes, there was an uptick in the fourth quarter of 2021, but we see that stabilizing at those levels in 2022 first quarter. And I think those contractions are going to meaningfully come down because we are seeing more POGO activity come in. So the POGOs, which led the contractions for the last 24 months, are going to significantly slow down. They're going to start coming back in the Philippines. Next is that the BPO sector, despite all the talk about work from home, they continue to renew leases. And the contractions in the BPO sector in total for the last 24 months is less than 1.7% of their total footprint in the country. So the BPO sector is not contracting meaningfully. They just let go of excess space and excess capacity as a result of clients in the travel sector and the tourism sector, but otherwise they continue to grow. Next. The REITs. So for those of you who are reluctant to invest in real estate but cannot stomach the volatility of the stock market, the middle ground is investing in the REIT market. And this is the best play between property and stocks. Next. And I mentioned about capital values. This is just some of the transactions all throughout the country in the last 5-6 years. And you can see, despite COVID, despite 2 years of COVID, 1 quarter of Russia crisis, and 6 months prior to elections, or 2 months now prior to elections, prices continue to climb. Next. Condo market, so residential market. Number one, land prices continue to climb. Ayala Alabang has climbed 60%, appreciated 60% in value in the last 24 months. Punta Fuego has appreciated as much as 300% in the last 24 months. And the benchmark of all residential property, Forbes Park, is up 3 to 5% in the last 24 months. And bear in mind that Forbes Park being the most expensive place to live in, the entry price there is now about 800 to a billion pesos for the land, and another 300 million for a house, a brand new house to build in. And even despite those entry prices, those ticket prices, land values continue to climb. Next. And it's not just land and house, because the volume of transactions in the condo space continue to climb. And these ribbons of colors show you transaction activity in different price points in the condominium market. And you can see, despite all the lockdowns, there's still people buying. And I'm sharing with you information from 544 different buildings, 100 developers, and close to 300,000 individual units all across Metro Manila. So I'm not denying the fact that there are a few distressed transactions. There are quite a few distressed transactions. But the overall behavior of the general condominium market has been quite healthy. Next. And to stress that point, orange in this slide shows you capital values and blue shows you rental values. And two things hit the condominium market. The rising vacancies because expats couldn't couldn't come back to the Philippines. And because of the rising vacancies, you see a collapse in rent. Okay? In as much as 50% in certain cases. And the second issue is the contraction in the economy. We suffered a 10% contraction in 2020 and a modest expansion in 2021. Hopefully a better than modest 2022. And despite all these challenges, property values predominantly stayed where they were pre-COVID, if not slightly appreciated in certain places. And this would not be possible if not for the health and low debt levels of the private sector. Next. And to stress the point, what to do in this COVID crisis / Russia crisis / political crisis? Well, please buy property, because this combination of events has just slowed down the appreciation of real estate. And these are different assets across different townships, across different developers, and how they have performed in the last 12 years. And the compounded annual growth rates are almost double digit for a majority of these assets. And so what I'm saying is that, okay, instead of growing 10-12% in 2022 and 2021 and 2020, those capital values are probably going to grow to maybe 3, 4, 5% in each of these years, a lot slower than the pre-pandemic days. And use this time to accumulate assets while they are appreciating at a much slower rate prior to 2020. Because just think, if with these three things combined and property prices have not crashed, what will the property market look like when all these issues are resolved? Next slide. And it's not just about Metro Manila, it's all over the Philippines. And buti sana if I'm just sharing with you one or two developers, I'm talking about a very wide basket of properties across multiple price points and geographies. And the picture looks surprisingly good. Again, I'm not a denier of reality. In fact, I have nothing but experiencing the harshness of reality throughout this COVID crisis. But what I do want to remind people is that in this ocean of bad news, not everything is bad. There are a number of good things happening to the Philippines that we cannot deny will have an impact to a faster recovery once we get out of this crisis. And with that, thank you very much for your time. And if you have any questions, I'm more than happy to entertain them.
All right, thank you very much, David, for that presentation. Clearly, you're seeing a lot of bright spots. Very optimistic indeed. Now, at this point, I would like to ask all of our presenters to please join me on screen for our panel discussion. We'd also like to remind everyone to please join the conversation, type in your questions in the Q&A tab found at the bottom of your screens. We will accommodate as many questions as we can. All right, so everybody's joining the panel now. Okay. So I want to start the first round. I want to throw the first question to Mike. Okay, I think we're adding everyone on screen. All right, so the first question I want to throw to Mike, the chief economist of RCBC. Mike, we've seen a significant repricing in terms of the Fed, the ECB. Give us your assessment of BSP's Governor Jokno's performance so far. I understand it's a hard equation for him. He'd want to hike rates to temper hot inflation, but not so much that it chokes growth. And he also doesn't want to be, so far off from the moves of his major central bank peers like the Fed. So what do you think?
True, Mimi. It's a delicate balancing act. The question is, would any tightening or rate hike by the BSP be effective in addressing this inflationary risk? Maybe not for now. That's why it's because everybody else is still waiting for the potential second round inflation effects. So in terms of the wage hike petitions, as well as the petitions for transport fare hikes, because both of which would lead to second round inflation effects or the increase in the prices of other goods and services in the economy. So that's something that maybe that's the only time should there be risk of these, increase in prices in a large part of the economy. That would be the time to really send a signal for both being able to better manage both inflation as well as inflation expectations, the behavior of the markets. But for now, we haven't really seen that. We're still at an early stage. We're even still awaiting if when and where would global oil prices would stabilize. So currently, from at least as a consolation, we came from a peak of $130. Now we're doing around 105, 106. Just yesterday and previous 3 days, we were already somewhere between $94 to $96 per barrel. That's already close to the day before the invasion at $92. So those are important considerations, even for determining how much would wages be adjusted higher, how much would transport fares be adjusted higher. It's a matter of those decision points to make sure that any hike for both would be decisive and fair for everyone based on the latest realities. So it's still everybody else is still waiting for where would all this global commodity prices, especially would stabilize. So that would on, but of course, it would be a matter of time, realistically, because the Fed has signaled 6 more hikes this year. So that's a total of, well, from 0 to 0.25, it would range to around 1.7. It would go to around 1.75 by the end of the year. And maybe, so there's pressure for other global central banks to catch up for interest differentials, especially the developed countries. All of them came from zero, nowhere to go but up. And the fund managers are kind of sensitive to the interest differentials, the shift from funds from one country to the other, and at the same time, also in battling inflation. So maybe at some point later this year, the BSP has been very transparent in saying no rate hike. They reiterated it just lately after the war. No rate hike for the first half. Maybe the second half they may consider adjustment. So as I mentioned on the projections, there's a chance for a hike somewhere between 50 to 75 basis points toward the end of the year from the current record low. Hopefully that answers it. Thank you.
All right, second half of the year, 50 to 75 basis points. You just answered the question from July Rada. There's a saying that it's the central bank's job to take the punch bowl away just as the party gets going. Rob, this one's for you. The Fed and investors, they appear to be very afraid of tantrums when the punch bowl is taken away, like the Bernanke tantrum back in 2013.
Right.
Are tantrums okay? Are they a bad thing or are they okay?
I think personally, of course, if you're an investor, if you are a fund manager during these times, you'd like to avoid them. Fund managers like me, you want to be able to predict when things are going to happen. But, to be honest, they are okay because effectively you understand, okay, maybe interest rates are not in sync. Maybe interest rates have to be adjusted in one way or the other. So I guess in that sense, it's these tantrums are ways that the various economies are able to correct their prime lending rates. So I also want to say that these interest rates should reflect basically not actual inflation, but inflation expectations. So once these things are factored in, what are the prime rates now versus the prime rates maybe, as Mike said, maybe a month later, 2 months later, they could be very, very different. And if they are very, very different, these should be adjusted accordingly. But we've seen that sometimes the adjustment doesn't happen as quick as it should be.
So, Rob, you tell people to invest where? Is there like a recommended allocation, a mix, an ideal mix between fixed income, the riskier equities, or other assets like property? Is it there's a 60-40? Is there a 70-20-10?
Tough question, Mimi. And I was actually answering some questions on the chat. I actually started by saying, what type of investor are you? The more conservative guys, they don't want the volatility. Even if you say it's a fixed income security, it's a government security. But in truth, there is still some volatility. So for these guys, maybe the money market fund is the best thing for them, right? But I say that, but I tell them, okay, you may invest in the money market fund. You don't have the volatility, but the earning potential is a lot lower than investing in equities. For the guys who are willing to be more aggressive, then you can go fixed income. Then you can go equities. It all depends on what type of investor you are. That's where I start.
For a minute there, I thought, Rob, you were going to ask, what's your age? Then we'll decide the formula.
That's right.
Is it still 100 minus your age?
Yes, you can use that. But my usual style is I actually ask, what's your objective?
Okay. And how much how liquid are you? How liquid do you need to be at your current life stage? David, here's a question for you. Do you think we have the income levels today to afford investing in real estate at their current prices, which you just talked about? Prices kept going up despite the crisis in the last 2 years.
We certainly have more affordability today. 3 things. One is that the global supply chain for Philippines has made importing cheaper, right? Up until this recent Russia crisis.
Yeah.
Number 2, the per capita income is certainly much higher. Number 3, interest rates have collapsed. I mean, when my mom in 95, 96 borrowed a 2-year loan, it's a 15-year loan with a 2-year fixed. interest rates were at 18% at that time, you know, for a true middle class family. And today it's 6%, 7%. So that has made property so much more affordable for millions of people. However, we are still a long way to go. Just think about this, okay? What really excites me is the future. One day, the Philippines will have a mortgage market that will be viable for the middle class. And that's going to be exciting. It's going to create demand for tens of millions of more Filipinos across multiple generations that never own property, that will be allowed to own property because of this mortgage market. And what do I mean? What I mean is that we will be able one day enjoy interest rates fixed for 30 years or 25 years at single digit numbers, just like what we do in the West. In the US, you borrow for your condo in New York, it will cost you 2.7% fixed for 25 years. In Denmark, it is 0% for 30 years, right? One day, we will have a 20-year fixed at 7-8%, and that will be transformational for not just the Philippine economy, but for the wealth of the Filipino in general. And that will happen.
In our lifetime?
In our lifetime.
Okay. David, I'm very
Depending
curious.
on the next president.
Okay. I'll follow up that question later. But David, I'm very curious. You're saying that the property market stayed strong despite the pandemic in the last 2 years. What's the biggest deal that you closed in the last 24 months?
A sale of land in Bonifacio which hit a record high.
Mm-hmm.
And we could have done many more. I have to say this: we could have done many more deals, but we kept telling sellers don't sell. Right throughout this pandemic, we keep telling people don't sell. But unfortunately, there are some people who really had to sell because of how COVID ravaged their business.
Mm-hmm.
And so those are really reluctant sellers. But they were thankful that even when they had to sell, they still sold at record prices. And that is not possible without the fundamentals of the economy. And that's why I keep saying to the market that, hey, COVID could have hit us much harder, but it didn't, because there are certain things that very few people see, which is the strong fundamentals of the private sector.
Mm-hmm. David, are you allowed to share with us the price tag for that record sale in Bonifacio?
108,000 pesos per square meter of accommodation value, which is the highest, most expensive property in the Philippines.
All right, we're just going to have to do our own math there. Tonya, I want to go to you now. Those of us looking at the news day to day, what is noise and what is important? What do you think is the biggest focus for investors today?
Okay, the market is so volatile, and I agree with Rob. When people ask me, again, I'll go back to your objectives, right? What you want to do, what you want to achieve, how long you want to be in the market, and things like that. There's definitely a lot of noise everywhere, and it's filtering that out, and being able to make the right investment decisions based on the information that you have, right? So yeah, for me that's probably the most important, is really aligning the investor with the objective that they have. I don't, how should I say it? I don't you just tell them to just buy whatever, right? I'll normally figure out where they are, what they need, and then try and help them based on that. And then again, with the information that we have, at least from the information we produce, we use that to get them to where they want to be.
So Tonya, when you've got a client who comes to you and says, what do I do when my attempt at investing, like in stocks, fails? What do you advise them? Cut loss or wait?
Okay, again, so part of what I teach, and I do regular webinars about investment basics, and one of the most important aspects there really is risk management, right? I think a lot of investors don't take that very seriously, and there's a whole bunch of them who do, right? But really going back to fundamentals, setting up your risk parameters, and that to me is your first key. And even with those risk parameters, you can still go wrong, right? We're human, we get greedy, we kind of hold on a little bit longer, it tends to turn into a bad trade. But the reason you want your risk parameters in place is so that you can take as much emotion out of the conversation as possible. So for me, it's taking notes, reviewing your trades, reviewing your entries, your exits, what prices, did you trade too much? There's also such a thing as trading too much, right? And really analyzing these things, and that will really lead you to become a better investor, better trader. So yeah, just go over the notes, set your rules, and that should set you straight.
Tonyo, before we move on to the next topic, I remember there was a very beautiful but brief few weeks of panic selling back in March and April of 2020. It was bloody, all right? Yeah. And now we're back to 7,000, 7,200. Where do you see this index going? What sort of upside are you seeing?
Okay. We mentioned our targets are 81.74, I believe.
Okay.
The number, but 8,100, let's say. And here's what I've felt for a long time. And then the market, for lack of a better description, is cutting catena to move. I can see people want to get in. They're waiting for the catalyst. What's happening now is every time we get to a nice level where we break, resistances, Omicron, Ukraine, all of these things come in, fuel prices. So unfortunately, our market is long on bad news. We never ride the good news. Sometimes we do, but generally we succumb to the bad news, brings us back down, and then we have to rebuild, right? So, like David said, what's it going to look like when this is all over? And that's kind of where I'm looking, right? So I really feel that even in the downturns, there's opportunity, right? Your valuation, just look at the valuations that you want to interact. And sit on that, especially if you can sit for 12 months to 18 months. I think once this is over, you will be very well rewarded in this market.
8,100, we're coming from 7,100 end of last year. That's around 15% upside.
Yeah, 16%. Yeah,
16% upside.
From today.
All right. I think we're ready to take questions now from those who are attending this webinar. This question is from Paulo Fernand Estrabo. I think this is for Rob and Tonyo. Will the S&P 500, gold and silver go up further this year? There is a possibility that the S&P 500 will go above 4,500 level and also go 5,000 level according to the global news. Is there any Pera account, UITF tax-free in RCBC? Tonyo, Rob?
I think that's more for Rob.
Rob?
Right. In terms of the Pera account for RCBC, we don't have it just yet, but we're looking at establishing one at the soonest possible time. We are not an administrator, but we are looking at being a product provider. So that those Pera products, please watch out for them. They'll be coming out soon. The S&P 500 index, maybe I'll cede that question to Mike. I think you already talked about it. I don't want to steal your thunder, Mike.
Mike?
If I may, yeah. Well, I'd like to show briefly, the graph of the S&P 500. So it has doubled in 5 years, and it has tripled in 10 years. So that has been the behavior of the S&P 500 over the long term. So yeah, so where would it go? Well, 4,500 to 5,000 in the coming months is possible. We just show the graph here. So even despite the taper tantrum in 2013, that was just ignored. I think it just corrected by 7.5% from the peak back then, but you cannot barely recognize it anymore. So it has been going up, relative to the other asset classes over the past 5 to 10 years. So, why? Because valuations are supported by the biggest companies in the world, especially those in the digital businesses. I'm talking about Apple, Amazon. Well, lately you have the latest inclusions, including Tesla. They're benefiting from the new economy, the shift towards renewable power, self-driving vehicles, online businesses. So that has supported this, and also realistically, whenever there's a normalization of interest rates, especially now, global bond yields policy rates came from practically zero, so those are unusually low interest rates, so nowhere to go but up. So investors won't earn so much in terms of interest rate return for both short-term and long-term funds, especially in developed countries. So they'll just be burned. The risk of being burned is high. There's nowhere to go but up in view of the normalization, because they were really brought down to record levels to support the global economy's recovery from COVID. And now we have this inflation problem emerging, rearing its undesirable head right now. So given the investment choices, so where would the funds go? So definitely not in developed market fixed income, but they would always consider equities such as these. This has been proven whenever there are, these are past cycles. We came from the global recession in 2008, 2009 during the global financial crisis. So this would really benefit maybe among developed country investments. So as long as these digitally oriented companies, the components of the S&P 500 would remain to be responsive to the times. The shift towards digital businesses, the shift towards renewable power, electric vehicles, self-driving vehicles. So the valuations will still be supported and definitely away from fixed income. So hopefully that answers the question. Thanks
so quite simply, Mike, Wall Street is not a bubble waiting to burst, not yet.
Well, it has corrected lower revenue.
Okay.
We've seen it. There are times of sharp corrections during the subprime, during the COVID pandemic. That's one of the bigger corrections that we have seen. If I may share it again, well, there are pockets of corrections that we have seen.
Okay.
But look at during the subprime, the taper tantrum. It was 7.5% in May of 2013 during the time of Ben Bernanke. You can barely recognize it anymore at this point.
All right.
So it's a matter for them. Well, if there would be new Teslas again, even their very high valuations, very high PE ratios, new Amazons, new Netflix, the FANGs, as we may call it. And of course, things may change. Like, for instance, Facebook corrected lower lately because there's a threat from TikTok. So there would be dynamics such as those. And we all know that TikTok came from China. Hopefully that answers it.
All right. Clearly. Thank you so much, Mike. Here's a question for David. David, from an anonymous attendee. For real estate, how do you know if the value you are offered is a steal already? Aside from calling David, how else can we know?
A steal. I guess you just have to benchmark against what the market's willing to pay for today. Like, for example, if you have prime property if you have core property, let's say inside Forbes Park, and it's at the benchmark rate now is 450,000 pesos per square meter for Forbes, and you're being offered property at 420, 400, then I guess that by definition will be a steal, provided you have to remember that sometimes something might be too good to be true, and you've got to make sure your due diligence is crazy. I've been approached in the last 24 months by buyers who said, "Hey, I got offered this property in Bonifacio," and I'm surprised at how many brokers are pushing so many properties that are not really for sale, and that's because I've sold many of these properties myself, and I know the owners of these properties, and I tell these buyers to say, "Hey, that's not for sale. That's really not for sale." And ang kulit ng mga ibang brokers, and there are real scammers out there. And so you have to remember that in this climate, when everyone is so eager to buy something cheap because it feels good to buy something at a discount, sometimes they're blinded by that. and they fall prey to many scammers.
And David, where can we see the benchmarks, the benchmark pricing? Is there like a website, a government agency that
No,
provides?
because a lot of people purposely make it opaque. They don't like to be out in the market because of they're afraid of the taxman for one, and number two, they're afraid to be kidnapped, and number three, they're afraid that the relatives might run after them for more money and more whatever. So these things are naturally very private transactions, but you can access me through any way you like, if you allow me to give you guys advice. So, yeah.
All right. Thank you, David. Rob, here's a question for you. Are cryptocurrencies part of on the table for RCBC?
Not yet. Not yet. Obviously, it's not regulated, at least in the broader sense. But once they are, I think that's something that we can consider moving forward.
Okay, here's another question from Carlos Vicente Ventura. He says, I'm into fixed income placements like corporate bonds, preferred shares, and RTBs. In the near future, do you see rates going up for these products like 5 to 6%?
Well, okay. Based on how we see things, then I think Mike touched on it earlier. Interest rates have been trending up with inflation going up. I can't really make a call on maybe 5 or 6%, but we're not too far off from that right now. So if this person holds off a few months from now, I do see interest rates increasing a bit more. Effectively, the governor, our BSP governor, indicated that we don't have to follow the US. But over time, if the US increases interest rates by 6 times this year, the whole world will have no choice but to at least follow suit. Will they have to raise by 6 times? Maybe not, but they will effectively have to raise at some moment in time or later.
Rob, when a client approaches you and asks you, I have extra cash, should I invest my extra cash? Should I keep them in cash, or should I use it to pay off debt? What would your advice be?
Oh, okay. Generally, if that's the case, if the client or the investor has debt, I would suggest you pay off your debt first. Unless the only exception, because effectively, generally, interest on debt increases more than interest on your investments. So unless you're very good or you're very sharp with your pencils and you can compute and say that the earnings that you gain from your investments offset the interest for your debt, then that's the time you invest first.
And for new investors, should they invest in mutual funds or individual securities?
Good question. It's something that I would usually, two things. When you say new investors, let's just assume that these new investors don't have that much cash just yet. Considering the fact that if you're investing in fixed income securities, sometimes the lot sizes are a little big, 500,000, 1 million, then you have no choice but to go to mutual funds or unit investment trust funds. But if everything is equal, you have the money, then it goes back to what type of investor you are, what's your time horizon, what's your risk palette, what's your objective. Then you make a more informed decision of where you want to go.
Antonio, this one's for you. Of course, we're all searching for yields. With yields as low as they are today, when do you expect us to get back to a high return world? I mean, there's so much liquidity forcing investors out into the risk curve. Is that happening, or is it getting harder to outperform when you do stocks?
In this market, it's a little bit hard to outperform, definitely, right? Again, volatility. Like I said, and I showed earlier, we're looking at double digit on the 8 issues that we recommended among the many that we cover. I think Jollibee was at the lowest at 11%, and then I forget which one. One of the issues was at 35, 36%, right? So those kind of returns, if achievable in the next 12 months, are for me fantastic. So again, it's a matter of time. It's the market conditions where they are. Your time horizon, if you can sit and wait, as I mentioned earlier, the dips today are the entry points, really. Early on, I think when fuel and oil was at 130 or whatever it was, we were looking at, I don't want to say it here, but at as low as 6,300 was a possibility for us. Well, us meaning in the sales team and not research, they never put out that number. So I want to make that clear. But that's a discussion we had, right? Today, as Mike said, oil prices have tapered very just off where they were before the war, right? So get the way we invest so different. Personally, when I was younger, I was very aggressive, right? I was in and out. I got burned many times. I made money as well. Now I'm a longer term kind of investor. I try and espouse that view, right? The longer term gives you better returns, over time. But again, for me, sit and wait is at least 6-12 months minimum, right? Don't expect, quick returns. And again, impatience probably could be the downside for you, right? If you're in and you don't want to ride this out. But I think 6 to 12 months is the minimum probably that we're looking at here.
All right. Here's a question for David from one of the participants. Given that the current policy of the government contributed to the steady growth of the property market, what is your projection based on the promised policies of the leading candidates for presidency?
I think we just have to we just have to keep our expectations modest and be surprised at the outcome later. What is clear is that the last 24 months and the next 24 months will be the biggest injection of infrastructure the Philippines has ever seen, all across the Philippines, from very small provincial piers and ports to massive rail and road projects and bridges. And this is not going to stop anymore. If ever they do get stopped, siguro there will be 1 or 2 projects. But most of the 18 to 20 in the pipeline are all going to complete. A meaningful part of this has been completed, about 12 have been completed, and another 6-8 in the pipeline. And this is going to help us recover much faster. You cannot deny the impact of this to the economy in general. It will just make things a lot easier and allow people to move more efficiently in scale when we do go back to office and when we do have absolute unrestricted mobility.
David, for those who are looking to get in at this point, you talked about how prices have continued to go up, albeit modestly in the last 2 years. Some of us might feel, maybe I missed the train. I'm entering at an expensive price already. Where would you suggest we look? Where are the best opportunities to be had?
So just like in the different investment vehicles, I'm all for portfolio management, and people have to build recurring income at the quickest possible time, and only then will you look at borrowing to buy more assets. So the recurring income assets are normally found in BGC and in Makati. Yes, you can buy other properties cheaper, better, faster, but the safest markets are in BGC and Makati, where you can pretty much build almost anything, buy anything, and it will be rented at the highest values possible. Okay, whether good times or bad. When BGC and Makati are the first ones to rise in a boom and the last ones to contract in a crisis, always. And if you look at the last 30 years, that's been the case. So I would go safe, and when you build enough recurring income, then you start speculating in land, vacant land. You can buy land cheap everywhere in the country. The problem with land is that you only generate money when you sell it or when you start building on it. And the moment you do that, you become a very different tax entity also. And you have to ride decades of no cash and turbulence to be able to hopefully reap something from it. So yeah, so just do a portfolio, prioritize Bonifacio and Makati, and then after that, then you can be more adventurous with other places.
Mhm. There's a question from Chona, David. On real property, how do you think retail and leasing will fare outside of BGC and Makati? For example, she cites specifically Binondo in Manila and Cubao. Retail and leasing in Binondo and Cubao.
So Binondo and Cubao have to be going through this revival, right? Outside of Araneta Center, Cubao pretty much looks derelict and given into urban decay. And I grew up in Cubao in the 80s, in the 70s and 80s. I mean, my parents had stores there and I commuted every day from our house to Cubao for many years. So I know that up to now we still do business in Cubao and we're quite familiar what's going on there. Binondo, the same thing, between small lots and the restrictions of the historical commission and then the very Chinese-centric buyer market. There needs to be an urban renewal in these areas for it to prosper again, not just in a small geography, but in a big way. And I think that's going to happen with the right leadership in the local government. And Mayor Isko has done a fantastic job getting investors back to Manila, but that needs to continue for 5 more terms, 6 more terms, and the same with Quezon City.
All right, thank you, David. Here's a question. I think this one is for Rob. Someone is asking, I currently have fixed rate treasury notes, 2511. What are the advantages and disadvantages of having a long tenor of this kind of product? It's set to mature on September 2040. I was advised that the rate is currently at 87. I'm a bit worried since I bought the mentioned series at the price of 98. Should I withdraw and transfer to another series or just wait?
Okay, that's a good question. Effectively, the current price is 87, so the person has taken a beating because of rising interest rates. Personally, it's this. It is a long security. What are the advantages and the disadvantages? In terms of the advantages, I'm assuming since it's 25-11, your interest or your coupon payments are relatively attractive. They give you a good yield. That's the good part. The bad part is if you intend to sell it, meaning if you intend to sell it midstream, you have a lot of duration risk, or interest rate risk to minimize all these terms. Effectively, the longer the security, if interest rates move up, the greater the chances of you losing out. And that's what's happening right now. Interest rates are moving up, moving up, moving up. So if I were you, again, considering, your circumstances, are you happy with the coupon payments being given to you? Are they enough? If they're enough, then maybe you can hold back and probably sell it when the price is currently closer to what you bought it at. That's one option. But if they're not, then you probably have to have a deeper conversation with your Hexagon manager. But if I were you, if these are enough, you could probably hold on for the meantime.
All right. Are you expecting them to go up again?
I'm expecting interest rates to go up and bond prices to get hit, but everything is a cycle. Eventually, interest rates will normalize. Interest rates will probably level off at a certain point.
All right, Mike, here's a question for you. Which industry segments, aside from property, have high potential for growth for investments given the easing of COVID situation and the incoming administration?
Definitely, Mimi, if you look at the whole market, we have seen already the resumption of foreign tourism, February 10. So the hard hit ones, the beaten investments for tourism and related sectors, that would at least provide some glimmer of hope for them. Although the recovery may not be as fast, but we have seen the worst already at the very least, and it's already in the steps in the right direction. But of course, it's still the reopening story. Actually, the economy is practically, that's also the mitigating factor to counteract the adverse effects of the Russia-Ukraine war, to put the economy to alert level 1 nationwide. And there are even proposals for alert levels, even if that's not yet part of the protocol. So it's really to that extent, among other additional measures like the face-to-face schooling, the resumption of which that would also help boost a lot of the hard hit industries. Students haven't really gone out, and that's been reflected on foot traffic, on retail traffic. So it's a matter of putting everything into greater normalcy for the economy. That has been justified by the relatively low cases of COVID right now and the increased vaccination towards herd immunity. In fact, the country is even now donating some of the excess vaccines to poorer nations, to less developed nations. So, as long as there won't be the minimum health standards are maintained. We all know because COVID is not yet over. Many countries in Asia, there are still spikes. In China, in Hong Kong, in South Korea, and also in Germany, in other parts of Europe. So it's really hard to let the guards down, especially on the minimum health standard. We all learned from that lesson twice over. During Delta, during Omicron, we defeated both. That's a good signaling. So that's a way to sustain the recovery. And that's how the markets would perform also if the economy continues to open. So it would be across sectors. You look at the huge conglomerates. Past couple of days, since last week, there have been some. There's still bargains. That's the best opportunity to buy when there's a sale. When everything is cheap, because any pullbacks or long-term investors, sometimes they present themselves during these times of crisis. It's really of course, the level of risk is higher, but as the adage goes, fortune favors the brave. So that's on top of the favorite teams still, beyond Russia, beyond COVID, it's still the shift towards renewable power. And the supply chain that goes along. Electric vehicles, self-driving vehicles, all those is a supply chain. We have seen nickel, as I mentioned a while ago, at record high prices, and the companies that went along, because there would be massive investments needed for companies and countries, governments, to shift towards renewable power. Again, this is intensified by the war right now. You have to rely less on oil. You have to, and so that would still be the theme. ESG, because the rest of the world has been adapting that. Even after the elections, even the new government should be ESG compliant in terms of governance and everything for the environment, for society. Thank you. Hopefully that answers.
Yes. Thank you so much, Mike. You did mention the new government. So this is where I want to end this discussion. To all the gentlemen here in the panel, we're headed to the polls in 52 days. I'm not even going to ask you who you're going to vote for, but let me ask you this. What do you think should the next president's top priority be? The first order of business. What is executive order number 1? Be as concrete as you can, answerable by one line. All right, so let's start with Mike, Tonya, David, and then let's end with Rob. Mike?
Okay, that's one phrase. It's improved foreign policy. The PSEI has been stagnant for 5 years at 7,000. It's because of we all know what happened 5 years ago. Shift of foreign policy away from US, away from EU, and shift towards Russia and China. And so it's a matter of strengthening again, because the foreign investors, the bulk of which, the big funds, pension funds, retirement funds, the biggest fund managers come from these developed countries. So yeah, that would really help everything from FDIs, hot money across markets, even property. Especially now, with the further or sustaining the reform measures, easing of foreign investment limits, and as well as fiscal reform measures, especially now after the pandemic, there's a need to strengthen again the country's fiscal performance to make debt management more sustainable over the long term and for the coming generations. Thank you.
All right, Tonya?
I'm kind of with Mike on that. Definitely, China came to mind immediately. That's something that's got to be fixed. I think the pandemic's not over as well, and I think coming into 52 days is, I don't think it's going to be over at all by then. So that's something that's got to be addressed. So I think those are probably the two keys. Inflation, throw that in there, fuel, and all the stuff going on right now.
All right.
It's probably priority number 1, 2, 3, 4.
All right. Foreign policy still. David?
I'm going to pretend that I have high expectations on who it is the next leader will be. So, property rights and rule of law go hand in hand. You fix the property rights and the application of the rule of law, and in the Philippines we have so many rules, but nobody implements it. So we get these two things fixed and they go hand in hand, everything will get fixed.
All right. Thank you, David. Rob?
I think I agree with all the speakers, but I'd say it differently. I'd say governance, because from governance, everything else emanates. I mean, how do we entice foreigners or other people or other countries to invest with us? We have to highlight that we have a high level of governance. Governance also shows that we are very practical when it comes to our fiscal management. Governance in terms of infrastructure spending and the like. So if we're able to do that, then I suppose that we will be on the right track.
That's not a campaign slogan.
No, it's not. It's not. I think whoever gets whoever has the crown will have to make sure that that is communicated not only internally but on a global basis.
The crown is the crown, whoever swearing it. Thank you very much, gentlemen, for joining us this afternoon. That was indeed a very interesting discussion. Unfortunately, that is all the time that we have for Q&A. Again, gentlemen, thank you for joining us this afternoon, for sharing your time and your insights. All right, we've come to the end of this webinar. And for final words, we'd just like to say that, we've seen cycles come and go. And while nobody really knows where the market or the economy is headed in the short term, history will tell us that downturns are always temporary and may even be, that is, for the prepared and the brave, smart buying opportunities. On behalf of RCBC's Hexagon Club, I would like to thank our distinguished panel for sharing their insights, to my colleagues from the media for participating in this afternoon's forum, and thank you for joining us. Good afternoon and stay safe.